Good morning. Today is Saturday, the 14th of October, and this is the next episode of Two Grey Beards. Well, we've had some excitement geopolitically, and that still is dominating things, isn't it, Andy?
Yeah, sure is. Obviously, the tragedy in Gaza and Israel and the responses that are now in play are something that creates greater uncertainty in the marketplace right now. What I noticed though was that, we recorded the last episode of Two Gray Beards at, just before the Gaza attacks on Israel. And not much has changed really.
Yeah, no, we've had a lot of data and a lot of auctions and a lot of geopolitical uncertainty, but in terms of prices, very little change on the week. So let's
Yep.
just quickly run through on what happened last week, apart from geopolitics, and that maybe we'll spend a minute or two addressing that and the implications going forward.
Yeah, sure. So we got warm inflation data, warm employment data, nothing the Fed would like to see. And one of the things I noticed in particular was the bounce in Chairman Powell's favorite measure of inflation, which is core services ex housing services, and that was very warm at zero point 0.6, which is a 7.2% annual rate, and just not at all what the Fed wants to see. And yet, the Fed uh, speakers discussed that they were basically satisfied with the increase in the long term bond yields because that would do some of the work for them. And we're, I think 75-25 in terms of their commentary about whether another hike in 2023 was necessary, which is a little, which is basically where the market is.
Yeah, it's very telling that they keep on telling us that there's a lot of tightening in the pipeline. So they would like to say that they are done for the time being and see what the data comes back with. But the data keeps on coming back with nothing good. It's not surprising us on the downside at all, and that is what they would like to see. I'm pretty sure that geopolitics aside, what they would like to do is do nothing and let the real rates do the heavy lifting, as you mentioned. I don't know if that is realistic. I don't know how long that can be the case. If we keep on getting acceleration into December, do you think that they will then hike in December, or do you think they're done for the year?
So I think they're going to hike. I actually think there's a small chance that they hike in November, but more so than the market does. They rarely, if ever, surprise the market, but Powell has an ability to guide us higher in a speech right before they go in to the quiet period. And we do get GDP data and core PCE data in the end of the month before the meeting. So it's possible they could surprise us. The odds are against it, of course, but I do think they're going to hike one more time.
Right. So basically, what we're saying is that nothing has really changed yet. They're a million miles away from easing, a
Right.
million miles away. And the only question is it higher for longer at this level, or is it higher for longer at 20, plus 25, plus 50 basis points? And that we'll know sometime in the first quarter.
Right. And I think that it's important to recognize also that, since we discussed with you in July the idea that there was going to be a tremendous amount of bond supply, the heavy lifting that we're talking about, that the Fed is referring to, in that they think the higher interest rates on the long end of the bond curve, these higher real rates, are all have to stay higher for them to continue to do their lifting. So to the extent that we had a big bond rally for whatever reason, I don't, that's not my expectation, but if we were to I don't know, rallied to 10 years below 4.5, closer to 4.4. The heavy lifting is not being done anymore, and the Fed would have to act. And so it's just an interesting point. And, 2 weeks from now, around the Halloween holiday, we'll get another round of Janet Yellen telling us how much and of what quantity she needs to issue. And that'll tell what I think the next leg for bonds is. Other than that, the next 2 weeks are not going to create a big move in bonds either way.
Uh, unless geopolitics intervenes and we get a rally which probably won't be sustained. So maybe we should add some value since we've traded every single one of these Middle East crises since the 1980s, and there have been several. Well, Iraq 1, Iraq 2, a whole load of intifadas and stuff like that. Let's say what we think the end result is whenever it might happen. In the meantime, anything can happen, but the end result tends to be the same.
Yeah, I think that the idea is that usually what happens in these events is there is a lead up to the event, tensions rising, forces mobilizing, and fear increasing to a point that it is potentially, even when bad things do happen, the fear has overshot the event. And the one I remember the most, I'm sure you remember it fondly as well, was when James Baker, the Secretary of the Secretary of State at the time, said the I think his word was regrettably, which indicated that there was going to be a attack on Iraq for the Iraq Kuwait war, and we were going to send rockets into and troops into Iraq. And on that word, which was horrible news, the worst possible news, equities rip to new highs because the fear had overshot the reality. Equities had fallen a lot during that lead up to that event. And so I'm looking at this and thinking, okay, it's been a week since the Hamas attack, which is going to require a response. And we haven't had that real fear yet. I mean, there was a little fear trade on the close on Friday, but we really didn't have a fear trade yet.
Yeah, no, absolutely. Equity is closed completely unchanged on the week. The only thing that's really weak and keeps on being weak is the small caps, which, we've been saying avoid.
But that doesn't
Bonds
seem to
did.
be. You think that's crisis? That's Gaza related? I think it's just.
No, I think they're just weak.
Yeah.
The bond market has done absolutely nothing really. It closed very much where it opened. Surprising that the short end didn't rally more on fears, flight to safety. But I guess everyone is saying the Fed is completely stuck. Why would I buy 2 years, 40, 50 basis points below Fed funds when they're not going to ease for a very long time? I don't get very much out of that. The only thing that backed off 20, 30 basis points were real yields, which had spiked to over 2.5% last week, but and are becoming attractive. So, we haven't had real fear in oil. We haven't had real fear in equities. We haven't had real fear in anything. And therefore, probably we need real fear before we can play the other way.
Right. Fade the real fear, and we need to see it
Absolutely.
priced. One thing I would say on 2 year notes, I like to think of that as the classic fear trade. Everyone screams into 2 year notes and they rally and yields drop. And I agree with Nick that based on pricing, it's not that attractive because the Fed isn't going to react to that. But 5 years might be interesting. One other thing on 2 years, though, is because the data's been so hot, the fear trade might be masked a little bit by very hot data in the States. So there might have been more fear expressed in the 2 year, but at the same time, the data was so hot, that's sort of the opposite response. So, but the bottom line, the high level point is, that was a week of pretty bad news and the markets didn't really react much to it. And so there's nothing to fade.
What is going to happen next week? We've got very little data, really, and it's all second string data. Nothing that's going to change the Fed's mind, whatever it happens to be. And we've already said that the odds are, say, 80% that they do nothing and 20% that they decide that they have to hike. And I don't think next week, the data next week is going to change those odds by, even 10%, give or take. So what we are saying is that really geopolitics is going to be the driver for next week. And you just let it play out until you see the fear. Until that happens, there's not really a lot to do.
Yeah, I mean, we're going to get earnings, which I think we've all been saying it with strong GDP, strong and warmer inflation. Earnings are going to be great. The banks were great. Earnings will continue to be great. It'll be about future expectations. And so, that'll create some underpinnings to equities, perhaps. We'll see how they end up turning out. But our expectation is earnings are going to be great next week. And then the following week, we actually get more meaty data on earnings from the bigger cap stocks.
Right. So are we changing our macro outlook at all? And is there anything there that we think is attractive?
Yeah. So, for a long-term investor, and Nick's mentioned this a lot, and I think we have this view in our portfolio since at the beginning of the year, is that real yields are attractive and getting more attractive. And the question is, you know, why would you own anything else than real yields at this point? And I think the answer is that cash still is interesting and other things are interesting, but real yields could get higher, but they're worth acquiring.
Yeah. No, absolutely. I'm beginning to think that the fear trade, if it keeps on going in gold, especially, is an opportunity to reduce gold weightings and increase real yield weightings. I think it's very unlikely that gold can, in the long term, outperform real yields at 2.5%. Something which is giving you 0% real and basically is there to anchor your portfolio and make sure that you don't lose uh, real value over time, but gives you a zero return. I don't think can compete in the long term when real yields on 10 years are approaching 2.5%. I think that it's beginning to be time to switch those weightings around.
I agree. Yeah, so our portfolio is going to change a little bit. Again, taking advantage of some of the moves that are not extreme, but are heading in directions that make sense to change a little bit of our portfolio. And so I guess the first thing is we're going to sell gold, reduce it to half of what we own. What do you think?
Something like that, 3.5 to 4%.
Yep. And maybe take on a little bit more energy exposure by swapping some of our existing commodity ETF for one that's more broad.
Yes, more energy heavy.
Yep. Okay, that sounds about right. So what are you thinking in terms of bringing up commodities? A few percent?
Yes, no, about 5%, increase it from 3.5 to 5. And really, any kind of balance that we have over, we start allocating to long term real yields. Something like TIPZ, or I'll discuss all that in my segment next, and just basically give our subscribers ideas of what they can do over the course of the next week or two. Because as we said, we haven't really seen any fear. There is no rush to do any of these trades, but opportunistically over the course of the next couple of weeks, it's time to start doing them. And I'll make that clear in my segment next.
Great. One thing to note, if you have a Treasury Direct account, there is a 5-year TIPS auction this week. And if you're able to own physical bonds and have a cheap way of buying them, low commission way or no commission in the case of Treasury Direct, that 5-year TIPS auction looks to us to be worth owning.
Yes, that's excellent and a very good idea. And I'll cover all that, how they can buy it, how they can join Treasury Direct in my section next.
Sounds great. Thanks, Nick.
Thank you, Andy. Speak to you next week.
Yep.
Before I go into the specifics of what we want to do, I thought it'd be helpful to have a look at the year-to-date change of the various assets we have. Now, DJP, which is the commodity ETF we have, is down 3.8%, and it is the worst commodity ETF to own. As we specified at the beginning, we had to own it because this account then was not US registered, but now it is, and we can afford to swap it out for something better, and I'll cover that in a second. But what you notice here is that gold is actually up nearly 6% and will probably continue to go up Monday or Tuesday in case something bad happens in the Middle East. And I would argue that gold will have done its job then. Gold went up because real yields were low to negative, and now they're up to 2.5% in real terms. That is a gold killer in the long term. In the short term, anything can happen. But in the long term, it's definitely a gold killer, and it's time to start reducing these positions opportunistically. So we think it's time to reduce this allocation in gold. Gold has rallied because of this geopolitical situation, and it might rally more. That is why we're saying be opportunistic. If you see some piece of bad news and gold rallies $30, $40, $50, that is your opportunity. There has been no extreme fear as yet, but that is your opportunity to lower that from 7.78% to around 3.5%. And actually swap out, and we will be swapping out DJP. As you know, GSG is better, as we said here. Nobody should be owning DJP, and we can finally swap out of it. We've lost a lot of money on DJP relative to GSG, so we can swap out of it and go into GSG. As far as orders for next week, I thought I'd actually change it to something like this, because as we said, there has been no fear, so you can afford to take your time. There is no rush. You can act opportunistically, and basically this is what we will do. Whenever we can, we'll swap from DJP into GSG. We will reduce gold when it rallies. If there's a particular bad piece of news and it rallies in 10 minutes, it goes up 5%, we will sell it, and we will reduce it from 7.7% to something like 3.5%. And then we'll use the proceeds to increase GSG from the current 3.5 to about 5, and any money left over, we will start buying something like TIPZ, or something with a 5 to 10 year maturity area in TIPS, because as the yield approaches 2.5% or even increases over it, we can afford to start putting a little bit of money to work there. We don't want to do too much yet, because we don't know what Janet Yellen is going to decide to do for refunding on November the 1st. And as soon as the QRA comes out for November the 1st, we will know whether bond yields are going still up, in which case real yields will probably go up another 10 or 20 basis points, and that will be the opportunity to buy them. So there is no rush. A small, very small allocation to something like TIPZ, which is a 10 to 15 year, or more money to the 5 to 10 year area. And I've listed a whole load of ETFs are here for you. You can just press this link and you can basically take your pick. And that link will take you to this page with a whole load of ETFs. you will notice that the longer term ETFs, something like the Pinko 15 plus year, is down 7.7% on the year. Why? Because long-term tips have duration embedded in them, and they will more or less track what the long bond does. Sometimes slightly more, sometimes slightly less. So please be aware that if you buy something, a long tip fund, you are basically buying duration as well. And you will see that all the short-term tips are really not down at all on the year. So what I would suggest to you is to buy something like, with enough duration, something like TIPZ, which is my favorite at the moment. It's down 1% on the year, but it has enough duration in it to make it long enough for the time being, as I said, until we find out what Janet Yellen plans to issue in the fourth quarter, and then we can become more aggressive in case she moderates and buy, something like LTPZ. I think this is not the moment to do that. I would stick to something shorter on this list, or the maximum I would go to is TIPZ. One final word about the positions. As you know, we bought some QQQ call spreads, and they're not in here simply because we don't know whether they're going to expire in the money or out of the money, but they are in the broker statement. You can press the broker statement and you will find them in there. Everything else has been updated, and also we do have the TLT puts that we're short of, and it looks like that we won't be exercised on those. They will expire worthless, but both the QQQs and the TLTs expire next Friday, the 20th, and therefore whatever happens, whatever we're going to be exercised on, will appear in this table next week. But at the moment, I see no point putting it in there because we just don't know. It's just too volatile to know what's going to happen. Thank you very much indeed. I hope this has been helpful, and have a wonderful weekend.